Hello there. Well, over the past few years, there's been lots of talk about artificial intelligence, and those companies that are perceived as being the likely winners from this new trend, if you like, have done really, really well. We've seen their share prices rocket. And in particular, we've talked lots about the so-called Magnificent Seven big tech stocks. They've done really well off the back of this. That includes people like Alphabet or Google, who are, of course, one of the creators of some of the AIs that you can use. And it includes sort of hardware manufacturers like Nvidia, who basically produce the sort of microchips that are needed to run all of that data crunching that the AIs need. And as I said, their share prices have done really, really well. So there's been lots of focus on the potential winners from AI, but until recently, not been a lot of focus on the potential losers. Because of course, if AI can take up some of the things that are currently being done by, for example, other types of software, or by currently being jobs that are currently being done by humans, of course, then that can have a negative impact. So what we've seen this last couple of weeks has been quite interesting, really. And it started with Anthropic releasing their latest AI, which is called Claude Cowork. And essentially, this was designed and aimed particularly at the legal and professional services industry. And the difference with this is essentially it can do some tasks from start to finish. It's essentially done all the kind of legal and filing things and all that sort of stuff that's required in order to do a legal case. And it can do that from start to finish without really any human intervention. And that is seen as quite significant. And in particular, it's being seen as significant for certain software providers, those that provide the software that are trying to kind of help streamline those kind of services that are being offered by those companies. So we've seen the shares of certain companies in the kind of legal, professional, and then also more recently things like commercial property providers and even wealth managers being basically seen those share prices come off as new AI services, if you like, have been introduced that might work in those industries. So we've seen quite an interesting trend recently, and it's definitely investors are starting to focus more on the risks around AI than just the benefits. And we've also seen, for example, quite sharp sell-offs in both Amazon and Microsoft shares of late, both more than 10%. And it wasn't because, for example, that their profits weren't any good. Their profits were actually probably slightly better than expected. They are benefiting from AI in terms of their profits. But what they are having to do is spend a lot of money on capital expenditure on the kind of infrastructure needed to run the AI. And both of them, when they came out with their results, announced that they're going to spend even more money than was expected. And the expectation was already pretty huge. And investors are starting to focus on that and say, well, actually, I'm not sure I like that. I don't really see how you're going to make a return on your investment with that level of capital. And that's why the share prices fell. So what we've seen is something of a kind of rotation within the market and some volatility. So those tech stocks have started to come off and not done so well. But at headline levels, most of the stock markets have still done okay. In fact, some of them have done really well. And that's because certain other sectors have done very well. That includes things like materials and energy and things like just consumer staples and those sorts of things have done actually very, very well. And so markets that have got more of that in, things like the UK, emerging markets, Japan, have done well. Things that have got more tech, people like the US, have struggled. And we can illustrate that if we look at this chart. This looks at the US market, the S&P 500. And what we're essentially looking at here is two different versions of the S&P 500. In red, you've got the normal version of the index, if you like. So essentially, what that does, it's what we call market cap weighted. What it means is that in that index, the bigger companies have a bigger representation and the smaller companies only have a small part of the index. And that has therefore got a big chunk of the index in those Magnificent Seven stocks. And over the last 3 months or so, in sterling terms, that's been roughly flat. So in other words, basically, the market's gone up a little bit, the dollar's come down a bit, so roughly it's been flat. Over that same time frame, the Magnificent Seven tech stocks, which is the blue line on the chart, fell by about 6%. But the rest of the market has done all right, and we can see that in the green line. That is the equal weight version of the S&P 500. And basically that has the same 500 stocks, but rather than putting most in the big companies, it basically puts exactly the same amounts in each one of the 500 companies. And actually we can see that's done really well. That's actually gone up 5%, and it's gone up about the same time that the Mag 7 have been falling. So that's positive for portfolios because we hold an equal weight index tracker in portfolios. And as I said, some of the other markets have done very well, and that has been helping. So there's definitely been a change in trend. Now, as to what happens from here with AI, well, it's very, very difficult to say. We do hope that it's going to really help productivity, and there are some signs already that it's starting to make the economies more productive. And in fact, a lot of people think that here in the UK, we're actually well placed to benefit from AI because we have a very service-based economy, and we are starting to see productivity getting a little bit better. Whether that's because of AI or for other reasons, it's too early to say. On the downside, of course, there is an issue where an AI can do a job of a human just as well. And interestingly, we have started to see some layoffs in certain industries. Overall employment is absolutely fine and relatively stable. So at the moment, gains in jobs elsewhere have offset most of those losses. But some of those job losses are in industries you might not expect. So it's in things like the arts. So I know illustrators are really struggling to get some work because AI can do illustrations for pieces of writing, for example. And writing is the other one. So journalism, we've seen lots of layoffs at the Washington Post recently, because again, some of that can be done fairly effectively by AI. So where it goes from here is really, really hard to say. We as investors have to try and look at those opportunities, areas that we think can benefit from AI, but also consider the threats. And we have to make sure we position the portfolio accordingly. And of course, we need to make sure that we ourselves are exploring how best to use AI to make our decisions more effective and make ourselves more productive. Hopefully it will, as they carry on getting better, some of the things we do will take less time, and we have more time therefore available to do other things, do more research, do different things in depth and those sorts of things. So we are seeing a kind of a step change in AI. I think it will keep accelerating all the time, partly because one of the things AI is really good at is coding. So at the moment what we're seeing is every time we are seeing a new iteration of AI, it's been basically partly coded by the previous one. And that may become kind of an exponential curve. So it's really interesting, quite exciting in lots of different ways, but obviously, as always, we have to make sure we focus on the downside as well and make sure we protect the portfolios just in case it has a negative impact on some of those investments that we hold as well. So thank you very much. Hope you found that useful. We'll see you next time.